Hello, everyone. Looks like we got a Fed announcement happening. Dun dun dun. I see the disclaimer on our YouTube page. I don't know whether we're actually live yet or not. Hey, there we are. Awesome. And all right, so they're just playing the Fed video. I don't know whether you want to minimize that. Thank you, sir. And when you see Jerry walking up to the podium, tell me to shut the F up and throw that up on the screen if you wouldn't mind. Chris here's helping me out. Chris, total stalwart. And as you can see, it looks like the knee-jerk reaction. I get the impression the Fed did not lower interest rates here. Look at the currencies all coming off. Look at the bonds tanking too. Woo-wee. We always say, of course, that you never trust the first hour of trading following the Fed announcement. So we might find 1 hour from now the complete opposite image on our screens. But as you can see, the knee-jerk reaction, it kind of makes sense. Fed's not going to raise rates, not going to lower rates. It almost felt like they kind of set the market up a little bit there. Really did not like the way that they were rallying the stocks into this announcement. Then I noticed that they started to break the market a bit there. I had a fun little paper short going on NASDAQ. Just wanted to see how that played out. Let's see, did we get stopped out? Yeah. So they blew out the position at 50% of the anticipated move. The rule is move stop to scratch, so that's gone. And that makes sense. That's exactly what's supposed to happen around a Fed announcement, a whole bunch of nonsense. Now, of course, like we said, probably going to spend the next 20 minutes or so gyrating around here. It's not a bad opportunity for us to just take a quick boo at the broader picture, the bigger sort of message of the day. Here we are. So US dollar index, it was kind of interesting to see how this US dollar index was going to play out here. It did look like an inverted head and shoulders. Since we took that low out this morning, though, I think that that's off the table now. Whoops. Oh, good. Hit a button. Not quite sure what happened. I hope I didn't buy a whole bunch of shit. Where's the delete? Well, can we do that? There we go. So do we have an inverted empire pattern here forming on the 4-hour US dollar index? I think this is delayed, if I'm not mistaken. Maybe it might be real time. I don't know. It's the trading view chart here. So of course, we do watch the futures contracts, which are in real time. Kind of like what I was saying there earlier. It's a little surprised to see the way they bid the market up here into this event. They were even rallying the bonds smartly. I don't know. Were they thinking that the Fed was going to actually cut rates? That seems a bit screwy, but nonetheless. We did have news out of Japan overnight that they actually increased interest rates, and I think that caught quite a bit of the market off guard. I suppose you could also argue too that if they're increasing interest rates, that should be deflationary, and you might find that actually encourages maybe even money to leave the Americans and head back over to Asia and repatriate it back over there. We'll see. Only time will tell. So knee-jerk reaction on a half-hour basis. Looks like we've got tops working in all these interest rate proxies. And in our morning video broadcasts that we do, our daily brief, I sort of commented that I was a bit surprised that the bond market was as firm as it was. I think they're just waiting for the Fed to finally say, yes, that's it. We have seen inflation put back in the box, and the coast is clear. I don't think we're going to see that. I wouldn't even be surprised, to be honest with you. I would not be surprised if there are no interest rate increase, decreases, or anything over the next, I don't know, 4 or 5 months here, get through to the other side of the election. And ironically enough, that in itself might actually be the catalyst that really breaks the market. Because there was this funny kind of a religious zealot, I don't know. But he was going around the internet. He had a dream, and the Almighty showed him that Mr. Trump was going to get his ear pierced here in the summer. Then he was going to win the election. And then there was going to be an absolute economic collapse. And stock markets collapse. And in a weird sort of way, I've actually heard a lot of people say that that's pretty much business as usual. The question ultimately here was going to be whether the Democrats, and especially Mr. Biden, trying to sort of maintain status quo, make the public feel as though he has won the war on inflation. It was all him. And as a result, he should get another 4 years. Now that he's basically been, they pulled a coup d'etat on him, poor old guy. Joey, you did so great, Joey. You answered all the questions. I don't know if you guys have seen that from Dana Carvey. It's great to see Dana Carvey back in the public again. He's got a show on YouTube. I'm sure it's on other media channels. With David Spade. I tell you, that's a great show. I can't remember what they call it, but anyway, Superfly or something like that. So I guess just the point being that now that Mr. Biden has been relieved of the necessity to keep his scruples together through November, it'll be interesting to see whether this might turn into the same sort of scenario as when Junior Bush was in office and he hit his tenure. And there was no way in hell Dick Cheney was ever going to be elected leader of the free world. And so as a result, the Republicans in 2007, I guess, the latter part, well, I guess no, it was 2008. They all just bailed, and they just like completely just, just they sold everything before the election. And then into January, Obama inherited an absolute shit show. But the irony of it all is that that's actually what the new guy wants. And I have heard people say that Mr. Trump would actually prefer that the economy absolutely collapse in his first year in office. Then he can put all of his policies and stuff that he wants to in place, and then just spend the next 3 or 4 years just riding out the second term since he can't get elected again. Well, we'll see what happens. My hunch is that he is going to fight that, and that's what's going to cause a civil war down in the States in 2028. But we'll cross that bridge when we come to it, I suppose. So ironically enough, it actually serves. And if Camilla is elected and the economy tanks right off the bat, well, then she's got a clean slate. She can put all of her pieces together. She has 4 years to get the economy back on its feet. And then by the end of that 4 year period, people have completely forgotten. I mean, do any of you remember the stock market breaking in 2020? And the insurrection? I don't know whether you remember that or not. It's remarkable how these silly humans, it's about a 3 year memory window. And after 3 or 4 years, the humans like completely forget. And what I've noticed, especially in the crypto space, is like every 4 years, we get a whole bunch of new people that come into the space. And it's like we're speaking a completely different language. They'd never heard of Bitcoin before, never heard of crypto. And all of a sudden, what's a Dogecoin? Oh my God, look at it going, right? And new kids on the block, Solana and stuff like that. So you're going to have to train up a whole bunch of people on what the hell crypto is and centralized versus decentralized exchanges. So, just business as usual. So the knee-jerk reaction here on the announcement, and if maybe Chris, do you have like a news headline or something we can just throw up on the screen handy? I suppose I could probably find one here. Let's see. We could probably just, these guys probably have the headline. There we go. Fed signals first cut is closer. Never been closer. And oh my goodness, look at the fucking NASDAQ's up 500 points in one day. What the hell is going on here? Cats and dogs living together. So anyway, so there's your headline. Let's see. I don't know whether we're going to have anything here. Makes sense. Policymakers knows that there's been some further progress towards the 2% inflation objective, although inflation remains somewhat elevated. Also, recent indicators suggest that economic activity has continued to expand at a solid pace. Well, those two statements right there, bang, bang. I don't see how the hell you can lower interest rates in the face of that. Job gains have moderated. Oh, that's good. And the unemployment rate has moved up but remains low. Central bank judges that the risk to achieving its employment and inflation goals continue to move into better balance. Since the Fed does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. That to me sounds like a whole bunch of nothing. I mean, literally, there's just nothing. They didn't say anything here. Just same old, same old. So, I mean, I've said this repeatedly. I look at the U.S. economy very strong, and we are in the greed cycle, which means we should be leaning towards paper assets and moving away from hard assets and commodity assets. I actually think the crude oil market has topped out. And you just have these short-term aberrations, silly. I mean, when was the last time we actually heard that people were all happy-go-lucky and at peace in the Middle East? I don't think in my entire life have I ever seen that. I think I remember one time in 1999, was it Bill Clinton? It was weird though. He was standing funny because it almost looked like there was somebody kind of like on their knees between his legs while he was talking. I don't know. You guys ever hear about any of that kind of stuff happening with Bill Clinton? Anyway, he was standing there and he had the Israeli leader on one side and the remember the PLO. God, you don't hear about the PLO anymore. I think it was Yasser Arafat, if I'm not mistaken, but I might have that name wrong. And they were shaking, and it was like peace in our time, right, and all that kind of nonsense. All right, so what's the headline here? The yield on the 10-year Treasury note fell below 4.13 on Wednesday. What's that say? It's lowest in more than 4 months as markets assess the Federal Reserve's monetary policy decision. Well, that sounds like a pretty vague statement, and actually a little bit. Actually, I think. Well, how are the bonds doing? No, yeah. I mean, that's actually kind of in hindsight, and actually, this is pretty typical of the media. This is the way they operate. So they see this big push up here, and they're going to push out a headline that interest rates are at historic lows, right? No, everything's great. And what they fail to see is that isn't that a big fat M? Isn't that a sell signal? What the hell? So that's probably as good as the conversation gets. And actually interesting, on the site we watch, I have a nice little time-tested indicator that I like to follow to give us a reading on inflation versus deflation. And actually it just went M'd out. And you can see, I mean, there was the beautiful M way up there. So that's actually where inflation really petered out. And you can see this is the scary part about inflation is when it starts getting going and the socialists are just absolutely in love with themselves and they're just spending money like drunken whores. This inflation it just gets absolutely unstoppable. And then when you turn around and you go, oh, do you see what you stupid idiots are doing? And then they sit there and go, "Oh no, are you kidding? There's a whole new world order, right? Well, we're just taking orders from close." Blah 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 blah. So if anything, good to see, and you can see how long it takes to get this thing under control. And if anything, really good to see, we're starting to get some M's coming in here. This is the Americans. Unfortunately, if I showed you a country like China, the money printing is not stopping at all. And now the central bank here in China is actually starting to cut rates, and the fear is that the inflation is starting to rear its ugly head. All the, I mean, this isn't a conversation about China, so let's not even bother talking about it. But they're apples and oranges. And if anything, this is the reason why the United States is going to do so much better than all these commodity countries going forward, and why you should stay the hell away from a country like China is the at least down in the States, reason sometimes rears its ugly head. And I think that, and actually, I was showing the site members recently. I don't know whether we can show it on TradingView, but the retail sales numbers, they got absolutely out of control there when the socialists were just running roughshod. And you actually had people like Stanley Druckenmiller actually publicly step up and say, "You stupid idiots, raise interest rates now. You are destroying our society and you are destroying our economy." And as soon as that message was conveyed by Mr. Druckenmiller, the U.S. Federal Reserve Board, because keep in mind, all the U.S. Federal Reserve Board all they are is just a cartel. I mean, they're just a group of bankster crooks that are all working together. Every other part of our society, cartels are illegal, but for some stupid reason, cartels in the banking system actually are acceptable. I don't know how the hell that works. That's how, screwed our society is. Anyway, so the bankster cartel uh, paid attention to people like Mr. Druckenmiller, who are probably smarter than the whole damn cartel put together. And the Americans got some religion. They got their act together, and it looks like they're getting in front of this inflation problem. We want to see M's in this, and we want to see a lot of M's. We want to see this thing breaking below these lows here. And then we know that the inflation problem, for the time being, has been put back in the bottle. And my hunch here is that if Mr. Trump actually does win and the socialists are put back in the closet, then we'll probably go back to a more deflationary type world. You've heard Mr. Trump say repeatedly, "Drill, baby, drill." So, this image right here, I actually think that the oil market is topped out. And if we look at this thing from a longer term perspective, I think actually the top of the market came in there. So there is that sort of inflation deflation picture. And I've always said that energy is the leading component of the commodity cycle. So this is the first commodity market that should break. And then all the other commodity markets, they all sort of follow suit. And ironically enough, the last commodity market to break should be the metals markets, the gold, the silver, all that. I would actually argue that the gold and silver are still in the upswing. So, and actually, I think there's probably still a long way to go in gold. But anyway, so point of the matter here is if Mr. Trump does win, he has publicly said, "Drill, baby, drill," and I think that's sort of the catalyst. And it's ironic how we live through these fear greed cycles, and you're like, okay, well, now we should expect 17 and a half years of U.S. dollar strength, 17 and a half years commodity weakness. We don't really know what's going to actually cause it. But it might just be something simple as Mr. Trump coming into power and just flooding the market with oil, which causes the commodities to break and the inflation problem to break. The US dollar goes crazy, tech stocks go crazy, and boom, you've got your greed cycle. Everybody's getting rich in .com stock land. And that's the way these damn cycles work. So, really, not a big surprise across the board. All right, so having said all that, let's go look at the short-term picture. Anything changing dramatically? Not really. It's interesting how the moment that they came out with that news headline about interest rates being as low as they were, and bond prices were basically, and these are prices. So bond prices were very low, i.e., yields moving up, and as soon as they came out with that headline, now you can start to see a little bit of bottom. So maybe that's the panic selling in the bond market is abated for the time being. We can also see a little bit of a short-term top coming in the US dollar index. Keep in mind, this is a 3-minute chart. So this is the kind of chart that I like to watch to just sort of get the short-term reaction from the market. Somebody sneezes or something and you see markets lock one way or the other. What we should see happen here over the course of Jerry's speech here today is we should see this go up and down and up and down and up and down. And, who knows how the hell this is going to finish the day. We obviously a large part of this audience super interested in things like Bitcoin and cryptocurrencies. And I actually have found, keep an eye on this through the speech. I've actually personally found that Ethereum actually works as a really good leading indicator. So sometimes you'll see these, the risk markets like the stocks all just sort of zipping up here. Then Ethereum's just not joining it. And then after a while, the stocks roll over and they head back down. So I'd also say, too, that you notice if we actually look at the stock market, we might go back into one of these scenarios where the large, big, mega caps, we rule the world, Nifty 50, whatever the hell you want to call them. We might be in an environment if interest rates are still high and the Fed's not ready to talk about lowering interest rates, where these guys continue to outperform. And yeah, you notice the Russell 2000 here, sort of the broader benchmark, the broader stock market. A lot of these, there's tons of these zombie companies in our society that are in the Russell 2000. Just the way you saw exactly like Japan there over the past 10, 20 years, that they just keep limping along. And they're very interest rate sensitive. So that part of the market just will not rally as long as rates are still up and there's no talk about lowering rates. So interesting to see Dow pressing higher. NASDAQ looks like it's pressing. Actually, that's the S&P, beg your pardon. NASDAQ looks like it's trying to press up against the top, but the Russell 2000 it's actually still got M's working very comfortably. So that's something to keep an eye on. Also, too, the propensity for the Fed to actually lower rates going forward. We probably one market we want to keep an eye on is this guy here, the high-grade copper market. So they always call high-grade copper the professor of economics. Interesting how we did go up and tag good old Feigenbaum's up there. That was just a little bit too far, too fast. And now we're working bare ABCDs. So no real sign of a bottom here yet. We would like to see W start coming in here. But this is probably your number one indicator to refer to as for sort of the oomph of the economy right now. And the oomph of the economy is unoomping, if that is a term. And it does look to me, A, B, C, D, that we still got a little bit further to go here. So it does look like we're banging up against a long-term trend line. The only problem is just, if anything, I've warned people repeatedly, especially in things like Bitcoin, just a tag of a trend line itself is not a trade signal. If I wanted to short this, which I don't think is a very good trade location, I'd want the market to be below that trend line and then give me M structure to justify thinking lower. And then conversely, if this is still a bull, I want to see W's come in above that trend line, showing that we've tested it and we've actually rejected moving lower and we're going to start moving back up. So right now, Professor of Economics is just messing with the market. If anything, that looks like a megaphone, which means we probably, through this whole election event window, you probably see something along those lines. Keep in mind, Wyckoff check. Usually markets like to check breakouts. That's a little bit lower. And of course, the ABCD is still looking for a little bit lower. So this in itself is actually telling us that, heading into this election event, I don't think you should expect the market to go booming higher or lower. And if anything, when Mr. Trump was last elected, go look at what copper did. It was quite remarkable to see. All right, we any closer to Jerry taking the podium here? What do you think, Chris? 5 minutes. All right. How the hell else can I fill in 5 minutes? I suppose we want to keep a close eye on old corn. Keep in mind, we actually do have short setups still working in Ethereum. So there really isn't any reason to be bullish of Ethereum. And, I mean, if we want to take some time, the one thing I actually did like was seeing Bitcoin not go face ripping up into this event. The one thing that kind of bothered me about the broader market was seeing how, all of these stock indexes and stuff all just went crazy ass bullish into this event. That's not a good sign. You don't want to see that. So if anything, the fact that crypto actually was kind of sideways, if we can put in a nice base here, then actually we got the makings of a new bull. We're right up against trendline resistance. This is the summertime. This is when we're supposed to rally. The only problem, and you don't really see it that well on this chart, it's awfully messy. But the only problem I have with Bitcoin right now, I mean, I suppose you can look at momentum. There's a problem here with momentum. So that's got to clean itself up first. But the problem that I have with Bitcoin right now is it does look like this is on a very set sort of rally window, nice 2021 bars, then sell-off window from the peak to the trough, 48 bars, then rally window, 2021 bars, then sell-off, about 48 bars, rally window, 2021 bars. Do we have to go through one of these long slog consolidation, 48 bars through the end of the summer? I'll tell you, I don't like the look of this momentum. That does not look bullish. So if anything, what we need is all you Bitcoiners to get out there and buy some Bitcoin, get this thing up above this trend line. And really, if you are a Bitcoiner and you're wondering when the summer silly season is going to start, we got to see something like that. I don't know whether that's going to happen. And like I said, considering we just ran into this little sort of rally window ending into the FOMC here, I'm worried that they come out and they say, well, we're still data dependent and we have no intention of lowering rates until we see data that confirms 2% inflation over time. And today just becomes a big hurry up and do nothing. I might even argue that in the short term, I think that this is the top end of your range and this is the bottom end of your range. And until you see 69.9, 69.8, let's call it 70,000 bullish market structure above this trend line, capturing that breakout level, there's nothing here going on. And conversely, if we actually see the market break through these lows, that will actually start painting bearish structure. And if you're a fan of that ICT guy, who I think is pretty darn smart, then you start thinking things like market structure failures, and then 61.8 counter trend rallies will set up what I would consider shorting locations. So for the time being, hate to say it, but I think this market's parked. So, just to finish off this commentary, hopefully Jerry starts talking soon. If you are a crypto fan and you're wondering where we should see this sort of money flow through the summer, I'm keeping a close eye on this Solana versus Ethereum sort of battle for the hearts and minds of the meme coin world. And I do believe that Solana's got the upper hand right now, and I do see a lot of really juicy, interesting charts over there in Solana land. So, get out there and hunt your W's. I think there is going to be a summer bull market, but I think it's going to be in things like SOL names. All right, so it sounds to me like Jerry's taking the podium. I'll throw in my 2 cents if I hear anything dramatic, but really, this is all about Jerry's show here today. So let's sit back and listen to the comic stylings of one Federal Reserve governor.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices
wait a minute. Maybe
for the
I gotta
benefit of the
fast
American
forward this.
people.
Hold on.
Our economy has made considerable
stage?
progress toward both goals
there he
over the
is.
past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to 1 or 2 data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Howard.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all 3 categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Hey, Ed, thank you.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market, too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions, and that's what we want to see. We've seen that over a period of a couple of years.
Look at crypto
And
put in
a
that
move
bottom.
really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have 2 mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those 2 things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those things, two things are
market
working
sure is
together, and
loving
we're
what it's
factoring
hearing.
those both into our policy.
Chris.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of, I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates, and I think this is how we balance them. It's a rough balance, but it does feel like that. Again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, and we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs
There's
of its more
Ethereum
impact.
breakout here.
Steve.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now of thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market, and, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this. We raised rates a year ago at the July meeting, and if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market has, I think, unemployment was in the threes, mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have, we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most you would think in a base case that policy rates would move down from here, but I don't want to try to give specific forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Market likes what he's hearing. Oh, there was a Chair Powell. She wants his
Hi, Chair
baby.
Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that we're, to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report, and frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about, if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months we're reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably under 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point,
No Chair Powell from Ham.
risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer-Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation.
Did he just say that
if one is
the
farther away
cartel
from its
is
goal than
now
the other,
part of
then
the
you
U.S.
concentrate on the one
Constitution?
that's farther away, and you take account of the
My
time to
God.
reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. We get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just and then how is that affecting the outlook and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in and so much happening between now and the September meeting, and we'll make a judgment.
Edward.
Thank you, Mr. Chairman. Edward Lawrence, Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports, last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got another quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have we had a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney.
Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction, whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes,
bonds are super happy.
Should be on the way down. It should take some time to get into the full economy.
Professor of economics is having a great
economic
day.
activity, hiring, and that kind of thing.
That looks like a bullish boss
It's
setup.
not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. Just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late.
Look at those bonds go.
This is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria.
Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more, if it starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think, history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the...
That's because you guys are manipulating the yield curve, jerks.
So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Amir.
Ooh, she wants his baby.
Thank you, Chair Powell. Amara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data.
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the nonprofit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness, and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter. So it's just hard to measure economic activity. There are it's just difficult to do. So I look at both, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future.
Look how he's reading the script.
I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary. But we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically, we have our forecast. We can run
Interesting how the long bond
simulations
just
of
can't rally
different
here.
potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. We would just, that would just
No,
be
you're
a
not.
line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we've felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean.
Hello, Jean Young with M&I Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so...
Whoa, what's going on with Bitcoin?
The way the meeting is set up...
Look how the stocks are rolling over
the
here.
The first day, there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go-around. And then this morning, we have the monetary policy go-around. And I think in people's economic go and ending their
Ethereum just could
monetary
not hold
policy
that
go-around.
breakout, eh?
People express their views about this, and there, there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy, and so in the minutes we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming
Yes.
inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question, that is the case. That, as I mentioned.
Where's the script? Where's the script? Where's the script?
We think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off any more for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market. So that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see, which way the economy heads, and I think if we are to respond to weakness, we're certainly, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and a good labor market and inflation coming down.
Greg.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised
Not me.
by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And, you know, when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction
What's
function,
interesting
that's
about
a
all of
long
this is
time,
you notice he does
discussion
not
that
make a
people have had
single
forever.
reference to international risks.
I think people have understood
All he's
for
talking
a long
about
time,
is
actually,
inside
that we
the
were very
US.
focused on bringing down inflation.
He's
Nobody was
missing the
really
big
confused
picture,
about that.
or maybe he's
the data
conveniently
have,
leaving that risk
again,
out.
You've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk
Wow,
about
there's
central
a
bank digital
curveball.
currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things, the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
And that's all she wrote. Well, I don't know whether we have anybody actually over on the YouTube page watching. Oh, look at that. We do have a bunch of people. Hello. I'd be interested to get your guys' feedback of what you saw. That one thing that really jumped out at me was the way the short end of the yield curve rallied smartly there. Now, the problem here is this is a 3-minute chart. So I think you could make the argument that somebody in the lounge even posted this. This is perfect. Kevin posted, boring. that was perfect. Because the irony of it all is that we didn't really see a huge movement in the market. Our 4-hour US dollar index chart's probably the tell here. And you can see we've got huge tails, we've got huge wicks, and we're coming up near the bottom end of the range as we speak right now. But you could argue, an 8-hour window here, we really haven't resolved anything one direction or the other. And I think that probably articulates Kevin's comment there. Interesting to see the knee-jerk reaction following this meeting. Look how the stocks have all emmed out here on this lower time frame chart. So if anything, probably people who were buying into that, maybe cashing out, taking some profits here. Interesting too to see the gold ticking higher. Of course, if you've listened to me of late, I actually do like the gold market as a lagging sort of component of the commodity sphere. But we talked a little bit earlier about Professor of Economics and how Professor was going to act. So interesting how the Professor rallied up against its highs And just as it was trying to break out, you notice in comes M's. Yeah, the gold market is just going for it here. So a little bit of a disconnect there. And actually, this kind of, in a way, it validates a concern that I have in the market right now. And that is, if we go and look at the gold silver ratio, I think we're actually starting to see signs that the good times, and I've been sort of telling people, if we look at our interest rate matrix, I'm going to have to pull up my bookmarks here. How the hell do I do that now? Darn, I've forgotten how to do this now. I had it loaded earlier, but I got rid of it. Well, can't show you that. So anyway, forget that talk. But if we look at the gold silver ratio here, this is actually ticking in the wrong direction if you are an economy bull. So, when gold starts going crazy relative to silver, that's actually a sign that we're in some sort of crisis, and we got to sort of get our act together here. And it was looking like the economy was rocking and rolling, and things were humming along here. But you can see since the beginning of the year, they're trying to reverse a good chunk of that sort of bullish economic picture there. So that's a bit of a surprise to me, seeing that gold silver ratio tick back in gold's favor here. But maybe it makes sense too. One thing that I think we really need to keep in mind here is if we see these interest rate markets, and this is the bond prices, so that means yields are heading in the opposite direction. So if we see, especially the short term, if we see those bond prices ticking up, which means that interest rates themselves are coming off, then that will, and there is an image that I share with everybody. Maybe actually I can load it up a little differently. Let's try that. What is it? It's our 4-year Fed funds 4-year cycle. I think this is the one that I'm looking for. Yeah. So if we actually start to see this 2-year bond W out and start to move up, and I was mentioning this to Ivan over there at the Wall Street Silver, keep in mind that the market itself dictates what the Fed does. It's not the other way around. Everybody seems to think that the Fed and these central bankers push the markets around, but they don't. They just don't have deep enough pockets. So you notice that as soon as the 2-year bond, right, this yellow line, this is the 2-year US Treasury. As soon as it starts trending higher in price, lower yields, you notice the Fed gets its act together and it goes, oh shit, look, the 2 years, they're rallying, interest rates are coming off. And then, of course, through the crisis, bond prices going absolutely crazy, interest rates collapsing, and the Fed in reaction lowers interest rates dramatically. So really what we should be watching is how this 2-year bond is acting. And I had made reference to that earlier. I think that's pretty important here, folks. So you can see that 2-year note is really moving up smartly. And what I have noticed, which I thought was really interesting, was I don't know whether I can show you it here just off the top of my head, but I have been seeing a lot of people talking about the yield curve inversion, and when interest rates, when that inversion unwinds, and then what happens to the economy shortly thereafter. I don't know whether I probably misspelled that. I'm terrible at spelling. Yeah, I thought this was kind of an interesting study that we're seeing. I don't know whether I can show you one that's relevant here, but this might be a good one. And we're starting to see that yield curve starting to turn. This is from June of last year. Oh, are you kidding me? Is this some sort of oh, there we go. So, but notice, when that yield curve uninverts, look what happens shortly thereafter. Now, the only way this is going to uninvert, right? If we look at the dynamic yield curve from stockcharts.com, these guys do a great job. There is and actually interesting, even they're calling it flat right now, which is a bit surprising. Mind you, I don't know whether I've done this right. Oh yeah, there we go. Just even recently, right? We were painting inversion. So, has the curve actually started to uninvert? You can see it still says inverted there. I don't know where. Can we move this over? There we go. So you can see lots of inversion notation here. I don't think, interesting. So now they're actually saying flat. Uh-oh. So are we actually seeing this curve start to uninvert? And when it does uninvert, what usually happens? And, that is your 2-year going absolutely crazy to the upside while the longer bond just sits there. Remember, I had noted through the conversation that we didn't really see the long end of the curve here rallying. It's starting to move up smartly now, but we really saw the 2 years just taking off there like a rocket. So that's recessionary. Oh, what the hell? So, and I think I had mentioned earlier, I thought it was fascinating how this religious zealot guy said, I had this dream that Mr. Trump was going to get an ear piercing. That's Brian being stupid. And Mr. Trump was going to win the election. And then, oh my God, the economy is going to collapse on the other side of that. So if we actually have the rate cuts, and because the curve is flattening and uninverting, is this going to be like a self-fulfilling prophecy? I mean, you can see it here, folks. So that was very, very interesting. Of course, they were able to avoid the crisis because they literally jammed Congress there to just basically blank check the Fed, and they just went. Remember, Jerry called it his bazooka for the longest time there through 2020. He had his bazooka, and he was willing to blast anybody that was going to knock the market down. So this is an old image, right? This is 2023. I suppose we could probably find one a little, more to date. But if anything, it's a great, illustration. Do yourself a favor and go and get the real-time chart of this, and you'll see yourself that here in 2024, this is starting to tick back up. And, the dynamic yield curve here that I just showed you, you can see how just even weeks ago, this was inverted. It's now uninverting. And what does that portend for us going forward? Uh-oh, SpaghettiOs. And if anything, I've said this repeatedly, and I don't think a lot of people respect this. You heard him say that a lot of commentators were looking for U.S. economic weakness. I have been pounding the table that this is not the cycle to look for U.S. economic weakness. Where are you going to find economic weakness? It's going to be in places like China. And of course, China's puppet master, China, and Russia, and any country that's involved with that shit show, their economies are imploding. And it's actually fascinating to watch this all play out. So I don't agree with Mr. Powell there that the banking cartel is working 100% in the American public's best interest. I think they are working in the banking industry and the banking cartel masters, i.e., do yourself a favor and go look up who participated in the Jekyll Island fiasco there from the beginning part of the 20th century. Those are the people that the Fed actually works for. They don't work for any of us in the public. So I like Jerry. I think he's a really nice person. It's a little scary though, because he is a lawyer by trade, and also Lagarde over there in Europe. And I think that these lawyers, of course, have the public by the short and curly, so they know how to manipulate them and what are the right things and the wrong things to say. You saw how as soon as he sort of got cornered on a topic, he instantly looked down at his script and just read straight from the script. What am I supposed to say publicly to these people? So, ironically enough, with the whole situation, I think, and this is just Brian's opinion, I actually think that the people that give Jerry his marching orders are the same people who took a poke at Mr. Trump there a week or two ago. And ironically enough, Mr. Trump dying there would have been a nice, convenient solution for the 1%. The incumbents would have walked right back into office because there really is no realistic Republican candidate other than Mr. Trump. So if anything, this is a beautiful analogy of why, ironically enough, Jerry there talks about how it's very dangerous to get into the business of predicting the future. I actually think that the 1% were very comfortable with Mr. Trump passing away, there being a period of national mourning, and then us just, conveniently moving right along the script of the 1% and the Great Reset and this hyperinflating the money supply to justify $100 trillion in bank lending, as the plan. In fact, Carney there a year or two ago kind of spilled the beans as to what the banksters' sort of ultimate plan is. The fact that Mr. Trump survived, I think, has completely thrown a wrench into all of their plans. So at the same time, too, and I kind of said this to the audience here this morning, a big economic meltdown, like a recession here, right at the beginning of Mr. Trump's term, if he does win, I think actually Trump would love that. That would be perfect, because then he can look back and say, well, all these economic problems, they were because you got this old dithering idiot that completely screwed up my plans that I put in place 4 years ago. So now let's get back on script, and 3 or 4 years down the road, the economy's doing great again. He rides off into the sunset looking like a hero. Ironically enough, I'd actually also say too, if Camilla here can pull off some sort of Hail Mary win this fall, and keep in mind, I don't think that the 1% are done with their games. But ironically enough, if she comes into power and the first year or so of her initial term is weak, and we have a recession, then ironically enough, that suits her plans as well, because then she can say, well, we had a lot of uncertainty, and of course we're under a new leadership now and a new direction for our society. So let's all embrace electric cars and let's kill the oil industry. Anyway, so there's your FOMC event here for today. And ironically enough, the outcome of this, surprisingly, the casualty here, it appears, are risk assets, which I do find fascinating. So you can see clearly stocks not happy here following the event. They're coming off smartly. We haven't really broken down in earnest, so this might just be simply profit taking. But I got to say, who actually is getting beat up here is good old crypto. Oh boy, look at that Bitcoin chart. Ouch. So, if you were a Bitcoin bull coming into this FOMC event, unfortunately, I think we've all been told to just cool your jets. That is a lower time frame chart, so let's hope it doesn't translate into too much selling off the higher time frames. But I'd be curious just to see what the sort of the intraday charts are looking like here now. And actually, on a side note, while we were going through that presentation, somebody in the lounge had pointed out that it looks like the S&P 500 is breaking out here. And really, if we are a bull, remember, we don't really like having W's come in underneath trend lines. What we really want to see is we want to see a W come in on the other side of this trend line. That'll set up the bullish scenario. And interestingly enough, on sort of a side, if we put on an RSI indicator, the RSI, the way that I like to trade with it is this first W here, of course, stops the bear. You can clearly see, big nasty M's and then more M's. So the bear was fully in control. You can see on that second M how price just broke violently. So the first W here, it stops that bear slide. So if anything, all the bears have been told to cool their jets. But what we really want to see if you're a bull is we want to see this thing put in another W now. So the second W here should set up an actual buy signal, a trade signal. So we've got the sort of bears. You've been officially told to cool your jets. And as I had sort of said here, we're breaking down trend lines. What we need to see now, if you're a bull, is we got to see a bit of a consolidation here on the other side of this trend line, and RSI go in and give us another W here. And I think we're rocking and rolling. The problem here right now, though, is you can even see, and I'm sure Julian will be more than happy to point this out to you tomorrow, is this RSI downtrend line here is still very much intact. All we did was we just broke the sort of the uber sell pattern here on RSI. So what we need to see now, of course, is this higher time frame, bigger picture RSI downtrend line broken on a second W. And I think what needs to happen here is we need, well, we've got a bit of a reversal here. You can clearly see we rallied into the price gap, and the price gap itself, that's probably why we saw the market stall out there on those lower time frame charts, because as he was talking away, they were bidding the market up, then they filled the gap in, and you even heard me say, holy shit, it looks like people are taking some profits here. So based on the fact of the gap fill, that actually makes perfect sense. And I think, what this actually, I think is so perfect, because I think this is exactly, Kevin nailed it here. I actually think today was basically a non-event day. Sorry, folks. I don't actually think anything really happened here. If anything, it's good to see, though, the bears have been officially told, cool your jets. I mean, keep in mind, price did come off a nice chunk there. And now, if this thing really is a bull, now you actually want to see some bullish price action here. Right now, let's call it a dead cat bounce. And if anything, our knee-jerk reaction is we should look for a 50% retracement of that slide. And I think that's probably exactly what happened there. Boom, look at that. Nailed it. So I would imagine a lot of guys who stepped in on sort of a sweep of these lows, they were in there taking some profits on that event. So, but as I had said earlier, the market that actually caught my attention here, just speaking, is what the hell's going on with the stock market? Obviously people were taking profits into that. What the hell's going on here with Bitcoin? Kind of getting bitch slapped here. Excuse my French. So I'll just sort of finish off this conversation with all of you. Ye old corn. I'm kind of worried about this. I had mentioned this earlier in our broadcast on the site. We do a daily brief recording first thing in the morning. But I also said this to you. I kind of think that in the near term, this is sort of the bottom end of our trading range. This is the top end of our trading range, and we're going to get boom, boom, boom. 3-bar fractal sell signal if we actually go through. What the hell is that number? 65,302, it looks like. So we haven't failed yet, so that's good. But all you Bitcoiners, you got to step in there and buy this damn thing. So let's keep an eye out for that. I guess that's down that low right there, eh? So let's keep an eye out to see whether they sweep these lows. And interesting enough, you can see, we can actually even start doing crazy things like drawing Foggenbaum, since that is a double top. If this thing does start falling apart in earnest, we can take a look at that level, and then we can also take a look at these levels. So where the hell does this project? So interesting. Wow. So this double top that just fired here through that event, right? That was, remember I had said on the broadcast, I was like, oh, what the hell's going on there? Right? This M right here, that is now projecting the market wants to go after this low. And that was that fractal low. I suppose you could argue if we go through that, you could do a Foggenbaum off of this entire range. Ay, caramba. So this M right here, it's projecting that we want to head down into this 64 and change. So all you bulls, get in there and defend this thing. You really don't want to see the market trip up and close below this level. That'll be a bad sign for yield corn in the short term. And interestingly enough, what a big surprise. We're right at a reload short zone. And we're starting to see some failure here. So, I don't know. All right, I think we'll leave the broadcast at that. As I said, actually, maybe we just check in with you people over there on YouTube. Looks like we had a fairly robust viewership here. Michael says that Powell sure looks like a creep show. All right, there's a comment for you. That prophet is a fraud. Oh, there you go. Oh, is that in reference? You didn't like that religious guy? That was funny. Good to hear Brian again. All right, Rares. Hey, nice to see you, Rares. Hope life's treating you well over there in Romania. Like the scandemic sheep. Yeah, oh boy, silly. Yeah. Big companies that don't need to borrow money. Yeah, so Cotter making reference, who's most vulnerable in this economy? The small cap markets and the small stocks. And yeah, wow, look at this. Crypto's coming off a chunk here. But the small cap stocks, the Russell 2000, they are definitely more interest rate sensitive. So, but at the same time, too, it sure looks like you can really see the short end of the curve really outperforming the long end of the curve. And if that's the case, as I had said earlier, go do yourself a favor and go check out what the economy looks like, say, 6 months down the road, following the yield curve uninverting. And it's interesting how Jerry even made reference to the yield curve there. And you heard me chime in, go, that's because you're manipulating the damn curve. And you notice lately, oh, what a big surprise. Now the headline is, well, the Fed's curtailing its bond purchases and it's tapering and we're doing quantitative tightening, i.e., they are unwinding all of the yield curve manipulation that caused the curve to invert to begin with. So now that it's uninverting and we're going back to normal, don't be shocked if you see the economy tank here. And interestingly enough, energy prices are catching a bid again. So that might be one reason why crypto is not very happy here. But I do see the NASDAQ's relatively firm. I would have expected if energy prices were going to rally in earnest, I would have expected to see the NASDAQ roll over here. I tell you, there's crypto's having an awfully tough slog of this. And it was interesting, through that presentation, I was commenting that it looked like Ethereum was trying to break out. You remember me saying before we got going that I often seen Ethereum as a leading indicator. That doesn't look good, folks. The breakout did not come. And keep in mind, we already have short patterns already working. I mean, this trade is forever old, but it's basically the double top breakdown and it's still working. And I hate to say it, but I actually think we just got a new sell signal. This is that Mr. ICT guy and his, market structure shift, higher highs and higher lows, and then we break and, what's your fair value gap? I mean, I'm not quite sure how he defines all that, but I often like to focus in on 61.8 Mountain Man sort of retests following these market structure shifts. And notice, look at that rally right into Mountain Man, right into the downtrend line, major rejection. And what letters of the alphabet are you seeing now? So there's something wrong in Ethereum land. And I hate to say it, but I think this was a classic buy the rumor. They bid this thing up into the ETF. And actually, interesting, we have a rule at TRI. We can't really get a signal. I think you heard me even saying it until we actually get market structure on the other side of a trend line. And notice now, look at that, up, down, up, uh-oh. So you really don't want to see Ethereum go through this low. If it does, that to me actually becomes an outright sell signal. And keep in mind, we're already working a sell setup. This was a short off of this M top, take partial profits at 2-1, stops at scratch on the remaining, and you just let it work because you just don't know what the hell's going to happen here. So if this sell signal actually fires, oh boy, look where trend line support is all the way down here. Ay, caramba! And momentum is not looking happy here, folks. Something's seriously wrong in Ethereum land. And I think, as I said, I think I said it before, I think what's happened here is Solana has come along and just said, hey, you know what? We love Mr. Vitalik and his supercomputer, but I think we've built a better mousetrap. And, 500,000 coins were listed on SOL through the spring there. As a testament to, I think people are moving from Ethereum network to Solana to do all their fun meme coins and stuff. So never a dull moment, I'll tell you that much, by crackers. You Bitcoiners, you're supposed to step in here and buy this. What the hell are you doing? Why are you still listening to me? You should be getting off your butts and getting in there and buying Bitcoin. So this doesn't look good, folks. So anyway, okay, let's see if there were any questions or anything over here on YouTube. All right, real fine hogwash. There you go. Bitcoin not doing nothing. I hate to say it, Big House. Looks like Bitcoin's breaking down. And actually, you might even find Bitcoin and the US dollar index actually move in unison. How's the dollar doing? Yeah, the dollar's not too happy either. You can see on these higher time frame charts, like 30-minute charts, that was just sort of a big fluffy fluff. Probably there's your bottom end of the range, top end of the range. Now we're just flirting with the bottom end of the range. What's interesting is that maybe you see the euro is finally going to bottom out. Looks like the Chinese currency is catching a bit of a bid because commodities are doing better here. Interestingly enough, the bond market actually looks very, very happy here. The one thing, though, that's disturbing about this bond market is how the short end is really taking off here. I.e. Yield curve uninverting, i.e. Looks like 6 months from now we might have a recession. I thought you were short on ETH. Well, yeah, you saw that, Nick. Hopefully you saw that setup that we're still working there. And really what I was talking about through the broadcast, that was a 3-minute chart. We're just watching sort of the short-term gyrations of price through the speech. And that breakout just didn't have any legs, eh? They came right out to that level and then just puked right out. I hate to say it, like I said, Ethereum, good leading indicator here. I'd be surprised if the stock market could rally appreciably with the way that Bitcoin and Ethereum and that whole crypto market is looking right now. Holy crap, that does not look good. Cotter giving friendly emojis along with Kevin. Matt News, it seems. Okay. Nick says, where's the script? Where's the script? Where's the script? Yeah. Wasn't that funny? As soon as he got cornered on an issue, eyes down, read the script, don't deviate from the script. Wow. Michael says, nice show. I don't know whether you were talking about Jerry or myself. Waj says, thanks for showing all this live. Oh, cool. Glad you liked it. Alex says, war news in retaliation. I do think that the crude oil market jumping up smartly there overnight was all about, Israel went and basically directly attacked Iran. The funny thing about Iran, though, is they're kind of impotent. They tried to directly attack Israel, and that turned into a complete failure. So I suppose Israel went and assassinated one of the the leaders of the Hezbollah. I think that's the name of the organization. So yeah, I actually think that's the reason why crude oil jumped up as hard as it did overnight. I'm not quite sure about the stocks. I think that had more to do with Nvidia came out with a half decent number, and Nvidia was absolutely collapsing there yesterday. And I think sort of the shorters kind of went, whoa, 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 let's slow down here. So anyway, we'll see how that plays out. Richard John says, any comment on Hex and the Pulse X ecosystem? I can always make a comment. I don't know whether you're going to like what I have to say, but we can take a look at the chart. The issue there is, and this is my personal opinion, nothing more than that, is are you a fan of Richard Hart? Right? If you're a fan of Richard Hart, then you love Hex. If you don't like him, obviously you're not going to be a fan of Hex. And I don't think Richard really endeared himself with the public too much. And I think, if I'm not mistaken, didn't he get charged? And I don't know whether he actually got convicted or not, but there's Hex. Where the hell do we want to look at this thing? I always run into trouble here with looking at these because I always look at the wrong damn market. There's there's Bybit. I don't know whether you're on there. There's Mix. I guess we can look at it on Mix. Yeah, is this a commentary on Mr. Hart kind of getting bitch slapped there? I don't know whether is he in jail? Pulse chain. All right. I don't. Is this Hex? Am I thinking about something completely different? I could be. If this is the asset that you're interested in, I might say, if you are a little old lady and you're interested in just taking a position because this thing is against the bottom end of ranges, okay. Do I actually have a trade setup here specifically? I think you could argue you're at the bottom end of the range. The only problem is we just keep making lower highs and lower lows. Looks like we just made another massive lower low. And we always say wicks and tails like to be eaten. So that big old tail there's got basically a magnet on it. I would change my opinion of this thing if I saw the market trade up through that level, right? Because then you get a big fat W. Might even be a cute little W that forms in here. If you're a trader, I suppose you could maybe argue, let's come in here and let's take a shot against these lows. I don't know whether you want to risk that whole tail, but you can see there's a cute little W coming in on the intraday. So I'll use slick traders. If you took a shot against this and just risked against these lows, it's not a terrible idea. It does look like we have a bit of a bottom here in momentum indicators. Now, I don't even know if this is the asset you want to be looking at. It might not be. Richard, can you tell me whether this is correct? I don't know whether it is or not. So, but W's are W's. And of course, there's no guarantees from management. I think W's work about 60, 70% of the time. So on that perspective, you got about a 60, 70% chance that this W holds. And, if you rally back up into this wick, you probably should let some of it go. But if you're stopped scratch, you just ride the free position. Omar said he's the original Gucci sweater. He's definitely a character. One thing I will say about Richard, from my experience watching him, is he is a very, very smart individual. The only problem is sometimes you can be too smart in this world and you come across as cocky and a bit arrogant. And unfortunately, I think that's, some of the comments that he makes, especially his buying black diamonds and all that kind of stuff. And boy, I don't think he endured himself with the public too well through that. It just came across like he was really cocky. And the one thing humans don't like is when you have people who are cocky. Richard says Hex is the original asset. Then Pulse Chain was created by forking What does it say? Ethereum on the 10th of May, 2023. Oh, really? That's pretty recent. That's only a year or so ago. So, Pulse chain. I'm not quite sure what you want me to look at here. When it's all this DeFi stuff, I have a really hard time. There's Pulse chain versus USDT. Yeah, well, and it looks exactly like Hex, doesn't it? So, same commentary I said before. I suppose if these W's hold, there is a cute little W. If you were a trader, you step in and you basically pull the trigger on these W's, you risk against these lows, live with the results. If you're an investor, and unfortunately this is probably going to be the case, do we have enough data to work with to actually make an informed decision off of this MEX? I don't think so. There isn't really much I can do with that. Have you got a place where we can look at the whole data from May 2023? I don't really like pulling up these DeFi kind of symbols here because you just get the weirdest information. So I'd have to have a chart that shows me all the data going back to what was that? It was PLS, just PLS. So this was this MEX. Gate.io. Actually, they've been around a while, but I would say Gate is a little bit suspicious too. All right, actually, we got a bit data here. So this goes back well before May 2023. Kind of looks the same as that Hex chart. So this is Pulse Pad. I don't think this is the same thing. So Dex bots, I think. Yeah. So you've had enough of this, Omar. I don't really see anything that I can really comment on here, Richard. I tried to help you, but I just don't see anything I can get too excited about here. Sorry. On balance, what I would say, if we just look at the broader crypto market, a lot of these names are trying to W out here at the bottom ends of their ranges. And I would strongly suggest, if you are a crypto enthusiast, that you find maybe, I don't know, 4 or 5 names that you like. We do have a list of fundamentally vetted names from TRI's CTO, Sjord, who I think is a very good crypto analyst. And I'm more than happy to ride his coattails. He has about I don't know, I guess better part of a dozen names that he's very interested in. In fact, I made reference to a financing he was trying to get into yesterday, and he's like, "You're not supposed to talk about that one, Brian." So I'm going to refrain from referencing any deals that he's trying to get in on. But my suggestion here for you is, this probably is a pretty good sort of note to leave off on. We are, oh, Jesus. All right. So we just smashed through that 2.618. Next 2.618 up on the docket is down here at 64 and change. And now, unfortunately, this is one of these scenarios where you actually have smiles within smiles. That's really bad. You do not like to see that. And this is like smiles within smiles within smiles. So this is like this level here, whatever the hell this is just the biggest brick wall of resistance now. And now, unfortunately, these smiles have all confirmed. So that means that we can actually draw fog and bombs off of this range now. Where the hell is that going to take us? Oh, my goodness. You ready for this? Do we want to see this number? And all you crypto kids, you probably don't want to see this. Oh, boy. Look at this. Whoa, this is a cool concept. If you're watching this, you want to learn TA. It's kind of a fun little side after our FOMC talk. This, my friends, is what I call confluence. So that's that's bothersome to say the least. When you have two fog and bombs line up so nicely together with each other, that's bothersome. So anyway, it doesn't look like crypto's really doing very well out of this in the short term. But what I was going to lead off with is, and of course, if we're going to head over, I honestly think through this fall, this is just a big hurry up and do nothing market right now. I was a little bit bothered that they didn't actually clean this up, because I think that this market is a lot like, I think it's a lot like this market here. So, 2014, 15, we bottomed, 2016, halvening events, all that. We went sideways. You can see how long we went sideways here. And then we started to break out in earnest. And actually, this was the post-halvening dump. And also, too, you notice, look how long we went sideways here. So actually, I correct myself. I don't think we're here. I actually think we're right here right now. Which means, just drawing fun squiggly lines. The halvening event, and I should probably wind this up, but the halvening event, I mean, there's the top pre-halvening event, and we did not break out to new highs for, this is a weekly chart, 27 weeks it took for us to cleanly break out through the top. So let's take that from today and let's see where we are now. So there's the halvening event. I think there was the top pre-halvening event. So 27 weeks takes us into basically the end of September. And actually that would make perfect sense, because that's basically when the Fed said that they're actually going to think about starting to lower interest rates. And it's when the Fed starts lowering interest rates that things like Bitcoin actually start taking off, because that's all about, oh, here we go, money printing again. Got to do whatever we can to save this fucked up economy. And of course, the banksters, they're lending money like crazy. So got to step in there and save their business model, yada, yada, yada. So set your watch. Middle of September, that's probably when the next Fed meeting is. And that's probably when Bitcoin's actually going to break out in earnest for our next leg higher. The good part about this is look what's coming ahead of us, right? Look at what happened the last summer season. Holy moly. Look what happened the previous summer season. Holy moly. Look what happened the previous summer season. Oh, look at this one. Well, it started here. Look at the breakout there, and holy moly. So, methinks there are higher prices coming down the road here. But ironically enough, back to Omar's reference to Gucci sweater wearers, unfortunately, the job of the market right now is to remove the Gucci sweater wearers from the market. We got to make them feel like absolute pain. And what I've often told people, and one thing that bothers me, and especially we saw it through this, and we see it through this, and of course we saw it through this, is where are the references to the suicide hotlines? We did see it a bit through here. Of course, the whole damn world went a bit crazy there. But one thing that kind of was missing through all of this is I have not heard anybody talking about suicide hotlines. And that is sadly a hallmark of crypto. Do we have to go through one of those kind of events before we get to this middle of September, the next FOMC meeting, where maybe they do start talking about cutting rates in earnest? Who knows? Only time will tell. So that's the one thing that kind of bothers me about this current market state, and the fact that we actually looks like we're failing up against the top end of the range here. We haven't really got any outright sell signal yet, because this candle did make a new high. At best, we're going to have to wait for another week. And then the week following that, that's when we will get actually our outright fractal sell signal on a weekly basis. You can see 1, 2, 3, your sell signal comes in here and boom, down we go. This one here, 1, 2, 3, this was sloppier than slop. Didn't really form, but you can see, look at that beautiful fractal top there. So this is only 1 bar. If we can firm up inside bar, don't go through that inside bar low and start to tick higher, great. Maybe we still got something to work with. But as I kind of said here in the short term, and I don't really like this, this is looking kind of nasty here now, folks. We're starting to see some deterioration here on the lower. Oh, look at that. We did go through that low. So that 3-bar fractal, unfortunately, has fired. So until we actually see a bullish 3-bar fractal, we can't be bullish here. And what you don't want to see is this sort of dead cat bounce straight back up top and then it fire here, because that's probably a trap. Boo, hiss, hiss, boo. All right, I think I'm going to try and stop talking now. We used to do a show on Wednesdays. Unfortunately, my co-host there recently, he was let go by the firm that he was working for. We can't dog that firm because he's on a severance package, and that's according to the rules of the severance package. He's not allowed to talk badly about the firm. So as soon as his severance package is over, then I'll start shitting on those people. Because frankly speaking, I'm pretty disappointed in the way they behaved. So anyway, that's your report here for today. So I think we'll leave it at that. Should get a nice fresh look, a little bit of a different perspective from Julian tomorrow. I don't know whether he's pre-recording his video or not. We'll see what his plans are. Thursday is his day. And I guess I'll see you all again on Friday. And if I miss you for that, tune in for the daily brief video that we do first thing in the morning, 9 o'clock Pacific time, noon Eastern time, early evening over in Europe. If I don't catch you for that on Friday, then you'll be able to catch me again on Sunday for the Broiler Chicken Show. All right, let's leave it at that. Have yourselves a great day. PMA for the win. Slow and steady wins the race. Hugs and kisses. Remember what your number one job is, folks. Actually, my camera's not on, so you can't see me scolding you. Anyway, and the only thing left for Brian to say to you good people is bye for now.